Hey everybody, this is the CRE Showcase Series. This is episode 3, and we are here with Rudy Krupka. He's a 1031 exchange specialist. Uh, Please leave your questions in the chat, and we will get to them at the end. Thanks so much. Let's get started. On to introductions. So I'm Mary Jane Karimi. I work for Cunningham Ventures. I've been doing commercial real estate for quite a while now. And basically, I look at industrial, retail, office, and biotech sectors. I am looking at getting into investing this year, so that'll be a new uh, step in, as they say. So that'll be fun. Um, if you need any help with buying, leasing, selling, I'm here to help. And Rudy, it's on to you.
Thanks, Mary Jane. Appreciate it. Thanks, everyone. Hey, my name is Rudy Krupka. I'm based in Denver, Colorado. I'm the Vice President of Strategic Partnerships for 1031 Specialists. We are a national qualified intermediary. And Mary Jane gave me the opportunity today to give you guys a very high-level overview of the 1031 exchange process, which honestly is a very simple process. It's been around for, oh gosh, well over 100 years and formed by our government and the IRS under Section 1031 of the Internal Revenue Code. And if I could explain this to anyone in an elevator, simply put, a 1031 exchange is the swap of one investment property for another investment property without paying capital gains taxes as well as other taxes that may accumulate based on your specific state. The real key difference between a 1031 and any other real estate transaction is very simple. The closing is identical with two exceptions. One, a client must hire a qualified intermediary like 1031 specialists. And two, sale proceeds can never go into your bank account or into the title agent's bank account. And I hear this all the time. I get a message that says, "Hey, Rudy, I just closed on an exchange, or I've just closed on a piece of property. I'd like to do a 1031 exchange." Basically, it's too late. You can never take constructive receipts of the funds from your investment property. It must go through a qualified intermediary. So basically, we work with three types of different exchanges. 90% of what we do is what's called a forward exchange, when an investor sells first and then buys within 180 days. A reverse exchange is just the opposite, where the investor buys the replacement property first and then sells the relinquished property within 180 days. And there's a third, seldom used exchange called an improvement exchange or a construction exchange.
Hey Rudy, why would somebody do a reverse exchange?
Great question. MJ, it happens when, let's say I'm in a situation where I know I'm going to do an exchange and I list my property. But the property I want to exchange into, which would be called the replacement property, is available now and I don't want to lose it. I don't want to wait until I sell my relinquished property. So what I'm going to do is I'm going to close on the replacement property first, and then I'm going to wait to close on the relinquished property, and hopefully all of that takes place in 180 days. It's sort of the FOMO situation, fear of missing out on an opportunity, Mary Jane.
Gotcha.
So why exchange? And this does vary, and obviously I always have to do the, seek CPA, seek legal advice, talk to your attorney. But there are as many as four different layers when selling an investment property. First and foremost is going to be your capital gains, which depends upon how long you held the property. Secondarily, your state income taxes will vary, and I will tell you, Florida, Texas are great, California not so much. There is a potential investment income tax that's applicable and depreciation recapture. All of this can easily add up to 40% or more taxes on a particular property. So let's look at what that looks like on, let's say, a lower end property. This may be a small single family investment. Your profit is $200,000 And before you know it, poof, $80,000 of that is eaten up in capital gains if you're not exchanging. But the numbers are even more drastic if we look at a much larger, let's say a commercial investment property, where 40%, and again, 40% is a baseline, it could be substantially higher, is going to eat a incredible amount of capital gains taxes that you give up to Uncle Sam. So think about what that additional $800,000 can do, not only in terms of buying a bigger, better property or potentially increasing your leverage on an investment. So there's two things that you need to think about to ensure that all of your taxes are deferred. Number one, and we're going to go into a little bit of the number examples and nitty gritty, is that the purchase of the replacement property has to be equal to or greater than the value of the net selling price of the relinquished property. And I'll show you how that works here next slide. And then reinvest the full amount of cash received from the sale of your relinquished property. Net sales price. This is sometimes confusing because people look at, is the net sales price the price that I close on? Let's say it's $1 million property, but there are allowable closing costs that affect the net sales price. Those costs include things like your broker commissions, your escrow fees, appraisal fees, and recording fees. But there are also several layers of closing costs that do not go into the consideration of your net sales price. Things like property taxes, insurance, repairs, maintenance, those are all not allowable closing costs. So in this example, your net sales price is $950,000, and that would be your goal for the replacement property, that it has to be $950,000 or greater, not necessarily the $1 million that you sold it for. And then the next question I get a lot is, what about debt? What if I have a mortgage on the property? So let's take a look at that exact same example. You have a sales price of $1 million. Your allowable closing costs give you a net sales price of $950,000, but you have a mortgage on it for $500,000, and your equity or cash back is $450,000. You, one way or another, have to either replace the mortgage for the same dollar amount on your replacement property, or you add cash into the close of the replacement property. I hope that makes sense. So one of the other questions I get a lot is, what if I want to buy a replacement property that's less expensive than the net selling price of my relinquished property? And you can. No one forces you to use all that money. You may have a situation where you need cash and you need to do a small cash out. What the IRS looks at, that any of that cash they refer to as boot, and you just pay the tax on that amount, not the whole amount. So you can always pull some cash out of a deal as well. Now, this is one of the confusing parts I hear about 1031s, and that is, what's like kind? People confuse like kind property as referring to property that is a single family to a single family, or an apartment to an apartment. And it's really not true. There are infinite options for like kind properties. The definition really means that it's held for business or investment purposes. And that means that you can exchange raw land into an apartment, and an apartment into industrial, a single family rental into a motel hotel. There are really hundreds and hundreds of variations in terms of being able to exchange into like kind properties. So, $1 million question is, do I qualify? There are some very simple rules that you must follow in order to qualify as a 1031. Who are you? You can't be a flipper or a developer. And what do you own? It has to be U.S. real estate held for business or investment purposes. I will tell you a little caveat is that we have done deals that are foreign deals, let's say in Mexico or in Europe, but it has to be a property held in that particular country. So it could be a Mexico property for a Mexico property. Those are very seldom done. Usually we do everything on U.S. soil. And when did you buy it? Believe it or not, the IRS does not have a hard, fast rule. 2 years is always a great rule. However, if you've had investment property even shortly greater than 1 year, The IRS doesn't look at how long as much as they look at intent. Did you intend to use it as an investment property? And so if I were sort of to qualify it into what's an investor versus a flipper versus a developer, this is how we would look at it. Look at intent. Was it a long-term investment? Was it held for investment? Did you hold it greater than 1 year or 2 years? And then can you prove, particularly on your taxes, was it rental or lease income? Anything else, there's going to be a big red flag when it comes to the IRS test, sniff test. So I like to put these 5 commandments in a PowerPoint just to sort of highlight the key 5 aspects of any 1031 exchange. Number 1, the business has to have been held for business or investment purposes. And by the way, not to get into a rabbit hole or nitty gritty, but you can also have a multi-use transaction. And what I mean by that is this happens a lot when it comes to farm and ranch property, where a home has been held for a primary residence, but the rest of the land has been held for business or investment purposes. You can still do a 1031 exchange on the rest of the land. You just move the piece that's your primary residence and do a 1031 on the piece that's only been your business or investment. So obviously that's why we say that primary homes and vacation homes used greater than 14 days a year don't qualify. And if you're wondering how would anyone know, most people do report that on their taxes. Commandment number 2, if you want to defer all taxes, you must 1, purchase a property that's of equal or greater value. And that's where we talked about the net selling price. And 2, reinvest the full amount of cash received from the sale of the relinquished property. Very simple. We sort of covered that already. Commandment number 3. And this is when we get into the timelines. You've always heard of these 2 critical timelines, 45 days and 180 days. So first, within 45 days, following the close of your first transaction, which again we refer to as the relinquished property, you must identify in writing up to 3 possible replacement properties. You can identify more than 3, but there's also additional rules if you do. Only identified properties qualify for the exchange. And when we talk about in writing, it's literally a template email that you would send to your QI like 1031 specialists. As a side note, this is where I always talk to people about planning. The more you plan ahead of time, the easier it is to facilitate the 45 and 180-day rule. When you list a property, I would already be looking at what property you want to replace it with. So commandment number 4, and this really has to do with 180 days. You have 180 days to complete both sides of the exchange, and this deadline is firm. It doesn't matter if it falls on a Saturday, a Sunday, or a holiday. People always get something confused too. They think I have 45 days to identify plus 180 days to close. That's not true. It's 180 days in totality. So you have 45 days to identify after you close, and then it's plus 135, which equals 180. And last but not least, commandment number 5, you have to use a qualified intermediary. Your broker, your agent, your CPA, your attorney, none of those people can be considered QIs in the process. I'm going to spend a little time on the next couple slides, and you can get this information off of our website, but there's several tools that we provide our investors to help them not only facilitate a 1031 exchange, but also educate. We have a deep master class that will send you an email, one email every single day if you're interested in doing a deep dive, and obviously it's going to go into a little bit more information that we covered today. This is available on our website, and you can also copy the URL here. Number 2, there's a great calculator that's also on our website, very easy to use. I always tell people, fill in the areas with red font, and it'll give you all the answers that you're looking for. We do have a PDF, which we refer to as the 1031 Bible, also a much deeper dive into the 1031 exchange process. And I know that Mary Jane's going to send you guys this so you'll have the URLs as well. And last but not least, we're the only national QI that's built an AI model. And so you can either answer or ask questions on the 1031 exchange process via email, or we actually have a telephone number. And so far, every time I've tried our AI model, it has yet failed to stump me. And if you want to do something silly, ask it for a 1031 joke. So that's it in a nutshell. If you have any specific questions, then feel free to call me directly. That scan code allows you to input my contact information into your phone. Don't hesitate to call to run through scenarios. That's what we do 90% of our time, is an exchange of ideas where you may be looking at something and I'll help you figure out if it qualifies or not. And if I can't figure it out, I've got a lot of people on my staff that can. So thanks for your time this morning. I appreciate it. And my apologies, I was late. My calendar didn't catch the time difference between the Mountain Time Zone and Central. So again, my heartfelt apologies, Mary Jane.
Yeah, no problem. I know, you live in Colorado, but do you service the whole United States, or are you
I
subject to just a certain area?
No, I actually work in all 50 states across the United States, and we have offices throughout New York, Florida, the Carolinas, Colorado, California. Did I say Florida and Arizona? And so we all work remote, the new way of working, but I do service all 50 states.
Awesome. And I did have a few questions. If the funds hit your account, is there a 7-day time period or any kind of time period that those funds can be reversed after you purchase or after you sell a property?
Zero. Once those funds leave, it's a dead deal. We can't help.
Okay.
Hard and fast rule.
And then I know that you mentioned if your property is being leased, obviously then it qualifies. But what if you want to put your own business in a property and then later on sell it?
That's a great example of, because it was held for business and investment purposes. So, for example, if I owned a dry cleaner and that dry cleaner had real estate associated with it, and my business is in that real estate as the dry cleaner, I can 1031 exchange that property.
Perfect.
Yeah, held for business.
Well, I believe that's all the questions that we have for today. But if you're looking to do a 1031 exchange because you're selling a property, please give Rudy a call, and I'm always here to help with any commercial real estate needs.
Thanks,
Thank you
everyone.
so much.